guys, it's Dana and it's time to talk about money. And in this video, I wanted to talk about mortgages and paying them off as fast as possible. So let's get to it. Okay, so you've got a mortgage in your life and you want that debt out of there as fast as possible. If you follow my channel, you know we're all about getting out of debt, and a mortgage is a debt. And if you've been researching different ways to pay off your mortgage, you've probably come across velocity banking. So in this video, I wanted to talk about that as far as what it is, how it works, as well as give you my thoughts on it, and then also give you some other ways you can pay off your mortgage. Also, some of you have written down below in the comments some video suggestions for me. Some of you have been watching some of my older videos, which, yeah, kind of cringy, but thank you to those of you who have watched them and recently left a comment saying, hey, Dana, maybe you could redo this one, update it now that it's been several years. And so I've added it to my list. And so please go ahead and do that if there's a certain topic or a video that you'd like me to remix or redo, or just a new topic altogether. I'd love to hear that from you as well. I did take several years away from YouTube and just returned recently. So I am excited to get back into making all these videos for you guys. And I've actually got a really long list, and so I'm working my way through it. This was actually a video topic requested from one of you, which is why we are discussing it today. Velocity banking is a strategy utilizing a HELOC or a home equity line of credit, which is basically a revolving line of credit using the equity in your home. And you have to apply for a HELOC. You have to have a high credit score, and you need to have, I believe, at least 20% equity in your home. And it works just like a credit card. You can borrow up to a certain amount of money and you have to pay it down. In its most simplistic terms, you open up this HELOC, and then the premise is you take your income, say your income every month is $5,000, and you put the $5,000 of your income into your HELOC loan, and then you take money out of the HELOC and you put it on your mortgage, and then you pay your monthly expenses out of your HELOC. So it's a lot of back and forth. But the whole thing revolves around the idea that you are taking advantage of the HELOC's simple interest calculation methodology. So it calculates interest on a daily basis. So you're paying down your HELOC balance in the beginning of every month. And then at the end of the month, ideally, you're taking the money out and putting it onto your mortgage, which follows a different interest calculation structure. So you have your amortization schedule with your mortgage. And the way your mortgage is calculated is different than the way it's calculated in the HELOC. So the idea really is you're basically playing games to save money in interest. And it's a viable option maybe for people. However, currently the interest rates on HELOCs are sitting around 8 to 10%. And a lot of people have mortgage interest rates that are a lot lower than that. So I believe several years ago, when HELOC interest rates were lower than mortgage interest rates, it kind of made more sense. But currently, because the HELOC interest rate is higher than the mortgage interest rate, I'm not sure that it makes so much sense anymore. Also, you're working off the premise that you're in a positive cash flow situation where you have extra money every month to be sort of putting towards the HELOC balance. And so and when you are listening to videos or even listening to me and you're like, whoa, that sounds complicated. To me, that's a red flag. So my opinion is that you're basically exchanging one loan for another when you use this velocity banking method. And you have to be extremely diligent with your budget. You have to be careful that you're not overspending with expenses, because using this method, you're using the HELOC to pay your expenses. So your income money, all of your money goes into the HELOC, and then you're taking a chunk of the HELOC and putting it on your mortgage to pay it down, and you're paying your expenses out of the HELOC. Some methods tell you to use a credit card, an actual credit card with a 0% interest to pay your expenses. But to me, it sounds like a lot of game playing and back and forth, and there's a lot of room there to get yourself into trouble in a really big way. So the risks there to me are that you're not being really diligent and careful and sticking to a strict budget and keeping track of every single dollar and what you're doing. And it gets too confusing, or you have a bad month, you have some situation going on with family or a health issue, and it can get really out of hand. And then you end up in more debt than what you started with. The other factor is that HELOCs a lot of times have adjustable interest rates. So the interest rate on the HELOC could start out, say, at 8%, and then it could go up even higher. And so you have to really read the terms. There's also fees associated with taking out a HELOC. So you really want to make sure that you're not getting yourself into trouble with fees, adjustable rates, things that, that you are not really envisioning when you first start out. Basically, debt is debt. We're trying to get it out of our lives as fast as possible, which means we have to put actual money towards the debt. And all of these different, schemes and things out there, people telling you to pay it off faster. I mean, there's really no magic pill for anything other than hard work, increase your income, and then put all of that extra money towards paying it off. And yes, interest is a factor, but if you try to start playing games with interest, I mean, really, you're just trying to get rid of it, okay? So no matter what your interest rate is, the fastest and most amount of money that you can put on it is going to get it out of your life as fast as possible. Not necessarily trying to spend energy and figuring out all of these different strategies and how can I, do this and do that, move this over here. And, I just think that's a waste of your time and energy. Okay, so let's talk about some other ways that you can pay off your mortgage. Let's just say you get your tax return every year. Every April, your tax return is $3,000. If you take your tax return and you put that on your mortgage principal, you make a payment and make sure you designate it towards principal. So that's very important. So you put that down to reduce your principal once a year, every year when you get your tax return, or say it's $3,000 every year. Of course, it's probably going to be variable. But if you just did that, you would pay your 30-year mortgage off in 25 years as opposed to 30 years. And depending on your mortgage balance, it could, you could reduce it even more. So I'm just basing it off of a $300,000 mortgage balance for 30 years. If you were like, no, I don't get a tax return, or I don't want to use my tax return in that way, you could take an extra $400 a month and put that towards your principal every month. Same thing, that's going to help you pay the mortgage off faster. Another way to do it is to do bi-weekly payments. So if you make a payment on your mortgage and you do it every other week, and you do, that's how you set up your payments, then by the end of the year, you would have made an extra mortgage payment for the year towards your principal balance, which again will shorten the length of your total payoff time frame. So you'll get it paid off quicker. Obviously, the more money you can put on your mortgage, the faster you're going to pay it off. There are so many schedules out there, mortgage calculators, where you can plug in the balance of your mortgage and then your interest rate and then how much extra money you're going to pay per year, per month, and it'll calculate it for you. It'll tell you exactly down to the year how long it's going to take you to pay it off if you add an extra amount per year, per month, whatever, and then you put that amount in there. It's going to tell you how quickly you can pay it off. Refinancing used to be an option, but if current interest rates, I'm not sure refinancing really makes sense for a lot of people, but if interest rates suddenly dive bomb and they go down, then maybe you want to do that and that might help you to save. However, because of the fees associated with it, it doesn't make sense if you plan to move in the next year or 2 or 3 years. It only makes sense if you plan to stay in your home for at least 5, 10, 15 years. Then yes, maybe you want to refinance to a lower interest rate, especially if it's at least a 1 point difference. You want it to be from 5 to 4% at least, or just sell your house altogether. And if you really want to, and downsize into a smaller home. I mean, I feel like, especially in America, we have these enormous houses, all this space, so much more than people have in other countries. Other countries, people are living in much smaller spaces and they do just fine, right? And then you can work on minimalism, reducing stuff. You don't need all the stuff that you have, perhaps. Maybe it'll be easier to have a smaller home with not as big a yard to maintain. So those are all things to consider as far as how to pay your mortgage off quicker, or how to, deal with mortgage debt in your life. Again, it's a debt. We want to get rid of it. We don't want to exchange one debt for another debt or possibly increase our debt because we get sloppy and we mess up or we get distracted and we don't pay attention. And then before we know it, we've got more debt than we started out with and all of this stuff all over the place that's confusing and overwhelming. And we just say, oh, I just can't deal with this. I don't even want to look at it anymore. And then before you know it, you've increased your debt by $50,000. And so be careful with that, right? All right. So please write down below in the comments. Let me know what you think of velocity banking. Hey, if you're using velocity banking and you love it, write that down below. Maybe you'll be able to help someone else out. I am just trying to help to explain it and give my own advice on it, my own opinion. Doesn't mean that it's the right way. Everybody's got to make their own decisions about what they want to do, and I'd love to hear from you. And if you'd like to start working on building your emergency fund, which is something that I'm working on beefing up, because I suggest a 1-year emergency fund at least, that's what I like to do, you can go ahead and watch this video here. And if you do, I'll see you there. Thanks, guys. Bye.